What's happening, guys? John Champion here, the FX Trader, and welcome to a quick video on candlesticks. Okay, so this is part of my online course that's on my website, thefxtrader.com, which has got everything you need to be a profitable trader. So, first of all, we're going to start off with this candlestick lesson, and what we're going to then do is move on to chart patterns and chart formations and a lot more technical stuff. So there are various other ways you can look at a Forex chart. We've got bars, we've got line charts, bar charts, we've got Heikin-Ashi charts. Candlesticks are generally the go-to chart purely because they're the easiest to read. There's a lot of information that you get from just looking at a candlestick than you would from a bar chart or a line chart. My personal opinion anyway, that's my personal preference. So obviously candlesticks have been around for a very long time, but if you want to dive into the deeper aspect of it, I do have a whole chapter on it on the course on my website, so you can go and have a look at it and you can read up on about it. So, but first of all, let's just get into a candlestick. So the reason we want to say we've got candlesticks is because we've got wicks and tails, we've got the body. You can see if the candle is red, you know it's a bearish candle. If the candle is green, it's bullish. Some charts, some people have them blue. I like to have mine blue as well. So it could be red and blue or red and green. So here you can see we've got the opening price. If the candle is bearish, the opening price is at the top and the closing price is at the bottom. If the candle is bullish, the opening price is at the bottom and the closing price is at the top. As you can see, obviously we open at the top, close at the bottom, open at the bottom, close at the top. And then you've got your wicks and tails. So the wicks are at the top, the tails are at the bottom. And that's just basically to tell you exactly where price moved to within that certain time period. Now obviously the time periods we're talking about are your time frames. Anything from a 1 minute chart to a monthly chart. So 1 minute, 2 minutes, 3 minutes, 4 minutes, 5 minutes, 10 minutes, 15, 30, 45, some charts also 45. You got the hourly, 2 hour, 3 hour, 4 hour, 8 hour, and then the daily, the weekly, the monthly. So that candlestick, so each candlestick represents a certain time. So let's say you're looking at the 1 hour time frame and we've got a bearish candle and it opened at the top, you can see there on this description, and then it closes at the bottom. But in that hourly chart, or sorry, hourly candle, we actually went higher than the opening price and lower than the closing price. So therefore that gives you your wicks and tails. So there are quite a few candlestick patterns, and I'm going to go through majority of them, but there are only a certain few that I look at, and I'll explain a bit why. Because to me, you want to simplify trading. You don't want to be looking for every little candlestick formation there is. At the end of the day, if you can get good at spotting 3 or 4 candlesticks patterns and just focus on banging out those, you can make enough money than if you were looking at 15 different candlestick formations and trying to trade all of them. Simplify your trading. You know, at the end of the day, we want to be full-time traders, you know, but we don't want to be sitting in front of the computer the whole time. You know, it's nice, it's exciting, you know, it's a thrill, you know, it is addictive a little bit, but I think on the grand scheme of things, I'd much rather make my money by sort of 10, 11 o'clock go and have lunch with the wife and the kids. Well, no, probably go to the gym first, don't lie. Then have lunch with the wife and kids. Then do something else. So the idea of this is to simplify your trading, and that's why you want to look at candlesticks, because candlesticks are the best way to do that. So let's go into it. So we've got the evening star pattern, and the evening star pattern is a nice trend reversal pattern. So there's obviously, you get the bearish and then the bullish. So if it's bearish, you've got the little candlestick at the top, as in the shooting star, and if it's bullish, we've got it at the bottom. So the evening star is a top reversal pattern produced by 3 candles. So the long green body can be found on the left, the reversal candle, and then a candle with a small body. The color is irrelevant, whether it's bullish or bearish, that's irrelevant. This is the reversal candle. So the candle at the top for bearish is the reversal candle, and then the third candle must have a long red body. It must be a big bearish candle. So the only disadvantage to this candlestick formation is that it does take a while to fall. As a result, you can get into the trade a little bit late. But generally, I think for me, if you're gonna go balls deep into this, that the small candle at the top, the minute it breaks that, I mean, my cursor's not going to work here. The minute it breaks the tail, I would go short, because it's gapped up, which means it has to push lower back down for it to be valid. And the risk to reward on it is going to be great, because even if you did risk that whole candle, it's usually a small candle at the top. For what you're going to gain, it's definitely worth it. So the morning star is obviously the bullish. It's the opposite of it. You're going to have a long bearish candle, followed by the gap, small either bullish or bearish candle, and then you're going to have the bullish candle on the inside. So just a reversal of the bearish candle. So the Greystone Doji. So there's quite a few different doji candles you get, and so the doji basically just signals indecision in the market. And I think there's about 4 or 5 different doji pairs that you can look at, but you've got a candle with a small body or literally no body at all, just the wicks, just the tails. That's it. So basically, it can also just mean where the opening price and the closing price are exactly the same, or thereabouts. So it just depends on where as well in the charts that these dojis are hanging around. So generally, a good place for dojis to be seen is at resistance and support levels, or if you're trading in a channel and you're at a critical support or resistance level, you'll normally notice a doji around that area, because the markets are indecisive. They don't know whether they're going to push through or whether they're going to stay within that channel. Okay, bullish. Okay, there we go. There's another one there. Okay, the hammer. So again, this is a classic trend reversal pattern as well. So if we've got the hammer, okay, this can be bullish or bearish. In other words, the success of the hammer is not dependent on the color, but rather the length of the shadow. So the shadow, or in other words, you've got your tail. So the length of the tail will determine how great the reversal is going to be. So some of the guidelines you need to identify before the formation happens is the body of the candle is at the upper end of the trading range for the period. So obviously your body is going to be at the top. The formation should have a very short upper shadow or no upper shadow. So it's either going to have no wick or a very small wick. and the tail should be at least twice the length of the body of the candle. Now, generally, this is generally going to happen. They're going to be a lot longer than that, sometimes 2 to 3 times as much, because the price is going to shoot down. Then the bulls are going to come in and go, yeah, I'm coming in here, and pushing the price right back up. So that, in hindsight, is your key signal. You want to be going long the minute it breaks that candle to the upside. So, and obviously, like I was saying before, hammer, the bullish, is found in a trend reversal. So you're at the bottom of a bearish trend. Okay, shooting star. Okay, shooting star or inverse hammer. Depends what you want to call it. There's plenty of other ones, but so again, it can also be called a hanging man as well. But same sort of thing. This is found at the top of a trend, top of a bull trend. So basically what happens is the price gets shot up. The bears come into the market and say, yeah, let's get down. And they try and push that price down. And that's when you're going to have that long tail. So a long wick, should I say. And from there, obviously you want to be going short in the market. Okay, bullish engulfing candle. I love this pattern. It's also one of my favorites. So okay, so the bullish engulfing candle can pretty much happen anywhere around a support and resistance level, trend reversals, channels, pretty much at a critical point where the market is going to turn. So the bullish engulfing formation is when either in a downtrend, like I was explaining, or when it's range bound, you'll see the candle. So the two candles must be different in color. So you have to have, for a bullish engulfing, the candle has to be green or blue. And it has to engulf. You can see here it engulfs the whole previous candle. So sometimes some people will use it as in the whole candle, including the wicks and the tail. So even if the body's not engulfing it, they will still classify that as a bullish engulfing. But for me personally, I think it's safer to bet that you would just take it as a bullish engulfing, where the whole body basically engulfs the body of the previous candle. Bearish engulfing. Okay, again, so same sort of thing. At the top of a trend, you're going to have a bearish candle that's going to be engulfing the previous bullish candle. So pretty self-explanatory. And again, we'll dive into the charts at a later point, and we'll actually go into how you can spot these and where you can spot them. So tweezer bottoms. So again, you get tweezer bottoms, tweezer tops, or another word is for it is a double bottom or a double top. So it's basically, and you also get triple tops, triple bottoms. So it doesn't have to be a double, but at the same time, the price is going to get rejected at that same level. So the highs and lows of the wicks are areas of resistance when the trading is formed. It would be ideal to be short as a close as possible to the highs. So in this case here, we're going to have a double bottom, and for me personally, the minute you see the first candle, the rejection, when it comes down, you would want to have a buy limit order at that level. Alternatively, if you miss that and you come, and let's say these are the daily charts, and you see the double bottom, you start rubbing your hands together and finding out where you're going to get out and take the most profit from, because you want to be getting in that very next day. So take these two candles, let's say that that's day 1, day 2, day 3, you want to be looking for your entry. Day 4, 5, you want to be taking profit. That's the name of the game. Tweezer top, double top, okay, same principle. It goes up, hits resistance, and then you want to be pushing yourself back down. So again, Price comes up, gets rejected. You got a nice long candle, long wick. The next candle, again, if you see the rejection, you want to be looking to go short at that level. Alternatively, if you come the next day or the next 4 hours and you see that formation, you want to be going short afterwards. Okay, so piercing line. Okay, so it's pretty much similar to the bullish engulfing in terms of the candle's usually a lot bigger, but the opening price is just above 50% of the previous candle. And then obviously this is also a reversal pattern as well. So the candle, the bullish candle, has to engulf 50% of the previous candle. If it does that, you know we're in the money. So the greater the penetration of the first candle by the second candle, the likelihood the instrument has reached the bottom of the formation. In the event that the bearish candle precedes the preceding line formation and surpasses the lows formation, it could indicate a further fall to come. So if it closes below the 50%, then you know that pattern is invalid. Dark cloud cover, same principle. At the end of the day, you're going to go up, and then you want to push down, and you want to pretty much engulf 50% of the previous candle. So 3 white soldiers, and then you also get the 3 black crows. So the advancing soldiers, sometimes referred to as the white shoulders, the advanced block, and the stall pattern are 3 similar candlesticks that consist of 3 bullish candles. So generally, what happens is you'll have, let's say, an impulse move down, you'll have 3 bullish candles for your correction, and then you'll have another impulse move down. So that's generally what happens. I think it's more of a continuation pattern than anything. And if anything, they're only moderate trend reversal patterns. Okay. 3 black crows, okay, the opposite of the 3 white soldiers. Each of the 3 candlesticks in the black crows of the pattern should be relatively long, bearish candlesticks, with each candlestick closing at or near the low price for the period. So it has to be continually going down. So down, 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 and mustn't be going across and sideways. Alright guys, okay, welcome back. We're going to just dive into the charts quickly so I can give you some live examples of some of these pairs that I really do like to trade. So obviously the ones that I do like are hammers, bullish engulfing, bearish engulfing, the doji is pretty good to trade, and the evening and morning stars. But we'll dive onto the most common ones, would be the bearish and bullish, as well as the hammer. You can see here we had a nice bearish engulfing candle. Okay, completely, this candle here completely engulfs this candle. What happens then after that is we normally get a bit of a pullback, a retest, and then we look to go long. Okay, you can see even here we had 2 nice hammers, and in fact it was a tweezer top, double top. So we had the 2 bearish hammers plus the tweezer top, and you can see the price went here, retested, and then rocketed down. Again, over here you can see the hammer on a trend line support, on a support level. Even on this support level here, you can see where we bounced off rejection, and then you look to go long. Excuse me. Same thing over here. We had the pullback. We then had price rejected from the 50 moving average. Nice bullish hammer, and then obviously further to the upside. Same thing on gold. You can see how powerful these patterns are. You can see that that was at a critical resistance level. We had a nice inverted hammer or a hanging man, and you can see that the move that it produced the next couple of days. So another formation that I actually didn't speak about, which I should have, is a inside bar. So you can see here it's the opposite of a engulfing candle. So instead of the candle engulfing it, it actually sits inside it like another word is I think it's a baby's. I don't know about that. Can't remember. But I'll call this an inside bar. So basically, we've got an inside candle that's pretty much enclosed within the previous candle. Again, it's at a critical area, so a resistance level, and again signifies a turning point in the markets. Here again, you can see we've got a nice bullish engulfing at a resistance level, huge bullish engulfing. You can see here at the resistance level. So again, you need to have a look at where you are on the charts, and that'll be in a later lesson. That you can see these patterns at critical support and resistance levels, or trend lines, or if there's a channel, or if there's another pattern forming, which is later in the course, you will then see where the markets are going to go. So the minute you see that candlestick formation is happening at that level, you know the game is on. It's time to get the whip out. Okay, again, so here we've got good bearish engulfing candle at a resistance level, bearish engulfing at a resistance level. Where else? Here we've got a hammer on a support level, and then we rock it up. Okay, so this is quite an interesting one here. So first of all, we've got bullish engulfing candle. Okay, you can actually see the candle just before is also a bullish, is an engulfing candle, but it's actually a bearish candle. So you can see that the bulls try to push the price higher. The bears came in and said, "Hey, hold on, cuzzy, we're not going anywhere just yet." But unfortunately, the bulls were too powerful the following day and smashed straight through. But if you look at what happened 1, 2, 3, 4 days prior to that, look at that doji candle. This one here. Look at the size of that wick. That's telling you that the bulls are coming in and going, time to frickin' play. It's our time. And of course, they just smash through the market straight away. Okay, so I'll make this a bit smaller here. So here we've got a triple top. Bang, bang, bang. But what's interesting is in the top here, you've got your doji at the top, or your shooting star. So again, let's make that a bit bigger. There you go, resistance. Engulfing candle. How's your mother? Go down. Just signaling here, inside bar. On a support level, bang, up you go. Bullish engulfing on a support level, bang, up you go. Okay, so here's an interesting one. So now we've got a double top or tweezer top at a resistance level. Like I said to you before, you got the rejection. Okay, you know that it's a strong level because we were rejected there before. Rejected there again the next day, you should be selling at this level. Probably have your stop above this high here. But when you think about where it can go to, your risk to reward is magnificent. So that's the other thing you got to think about. Okay. Excuse me. So again, obviously, rejection, you had the candle there, push back up, and then obviously back down. So we have to go into the weekly time frame here. You can see the rejection, but here we had a nice shooting star and a hammer. And there's a strategy which I'll do in a later video that basically on the shooting stars, there's your normal entry, your aggressive entry is there, your safer entry is when it travels 50% up the candle, and then your stop is a lot shorter than if it would be if you were at the bottom of this candle. So that is pretty much it. Those are the candlestick formations that I use. I do try and look for the others, but like I said, I don't try and clutter my mind with too many, and I try and focus on sticking to 3 or 4 patterns that I can easily identify at critical support and resistance levels. Makes it a lot easier for me to spot them, and then Bob's your uncle, you're in the money. So let's move on to the next lesson, which I think is chart patterns and formations. See you in the next one. See you soon.